Does whole life insurance actually work? In this video, we are going to look at a policy in action, specifically using a policy that was started back in 2017. We've tracked the cash value performance in our last video. We saw what has actually been produced in terms of real value, but now we're going to look at using the policy. Specifically, what does the policy look like if I decide to take loans against it for real estate? This individual, so you may recall in our last video, we looked at this guy, which was a policy he's funded $650,000 over the past 5 years. These are his real values for the first 5 years. And then we've got the in-force illustration we looked at in our last video that depicts things moving forward. Now, his question was, Steve, what does it look like if I decide to use my policy? One, I want to see income, but we're going to look at that last, income down the road. But mainly, if I use it for loans, if I see a piece of property that I want to take advantage of, show me what a $500,000 loan looks like. And let's take it a step further, because my understanding is that I do not have to repay policy loans. Most people get that it makes sense to repay loans or at least pay the loan interest, but he wants to see, what does the policy look like if I repay the loan? What happens if I only pay the loan interest? But what happens if I say I don't want to pay anything back at all? Meaning I paid in $650,000, 130 over 5 years. I'm going to pull out $500,000. What's the impact? Will the policy blow up? Will I still have money I can access? What happens if I take that $500,000 and I don't pay a penny back? We're going to look at that along with paying it back. We're going to look at a cash value collateral loan as well, which is a nice means to assign my policy with a bank or lender, obtain a line of credit against it, which one allows me to get the money a little bit faster, like a line of credit, a home equity line of credit. I can often get the funds the same business day. And then two, still, even right now, I can get a lower loan interest rate than what I can get directly from an insurance company. So let's have some fun here. What we will start with, here's the growth model, the $500,000 loan. Let's begin with the worst case scenario, shall we? So we're going to look at the policy that mirrors the original plan, meaning the $130,000 per year for 5 years. He's already made those payments, and here's what things look like moving forward. So this year, $657,000. Next year, paying nothing in, should have $687,000 if the dividend rate does not change. And a quick refresher, if you have not seen the last video where we got this from, was based on his in-force illustration. So as we go back up here, there we go. So here's his value, $657,000 today, or this is in 10 days from shooting this video, actually, June 20th, once all the dividends are applied to the policy. $657,000, he's in his 5th year, and then next year, if the dividend rate does not change and he pays zero into the policy, he'll have $687,000. So back to this guy. Actual policy we've got here. Let's look at things here. So his question was, if I take a $500,000 loan at some point down the road, could be right now, could be in a little bit, what's the impact of my policy? So let's take a look here. Let's get this just lined up properly. There we go. So we're going to take that $500,000 loan here in year 8. We could take it earlier, but what is the impact of that? So if this is you, and you're interested in using a cash value life insurance policy for real estate, this will give you a nice idea of what it actually looks like. This is an actual policy where we're projecting it. So let's take a look here. What we've got, $500,000 loan. In my opinion, it is always beneficial to look at a growth illustration side by side with a loan illustration. This way you can see the immediate impact. So when I take that $500,000 loan, if I don't touch it, if I had not touched it, my cash value would be what? $753,000. Call it $750,000, and your death benefit, $1.956. Now, if you elect to borrow $500,000, your cash value is your equity. The amount of money you can actually access is based on what you have in cash value. So it was $750,000. You elected to take a loan. Now your available cash value is $228,000. Your death benefit was $1.956. What's it now? Look at that. Anytime you take a loan against your life insurance policy, you will see a reduction, typically dollar for dollar, $500,000 in this case, plus the loan interest being withheld that year. But you'll always see a reduction of the amount you loan against the death benefit. So if you die with a loan outstanding, the life insurance company is on the hook only for the net death benefit. So if you don't have a loan outstanding, they pay out 1.956. If you take that $500K loan out and die the next day, there's the amount that's paid to your beneficiaries, the $1.43 million. So this example, the loan interest rate is 5%. $25,000 is loan interest after 1 year. So 5% of 500 grand is 25,000. Now what's happening in this example, you're not paying any loan interest. So what happens, $25,000 is added to the loan balance, and then what's 5% of 525? Comes out to 26,250. If you do not pay the loan interest, it will compound. So what we see occur here, your cash value is still going up. The reason why is because you're still earning dividends on your full cash value balance. So you're still earning dividends on everything you've paid into the policy, money and cash value, and what you've loaned against it. But loan interest is accruing just on the $500,000. So my particular question, if this is me, would be this: okay, I've got a 5% cost to borrow on this $500,000. If I don't pay it, can the policy sustain? Will it blow up at any point in time? Because my net earnings rate each year, when I look at the internal rate of return, does not hit 5%. Tops out a little under 4.8%. But I'm earning that 4.8 on a larger bucket of money than what my loan balance is. So let's see if it actually works as we scroll down here, shall we? Take a look. How far down do you want to go? Continues to appreciate. However, it never blows up, not at this level. But if we look at 90, let's actually go up to 85 first. 85 is where it hits its peak. So it's appreciated. This is the net cash value too over here, that 655 continues to go up. But from an awareness perspective, I really want to know, can I ever run into an issue here? And if the dividend rate goes down, or if I take additional loans and don't pay anything back, this is the kind of stuff I have to look at up front. Why does my value start to go down here? Well, that loan balance is getting quite large. If I die at 90, my loan balance is compounded to over $3 million. Now, if I died at this point in time, here's the net death benefit. It's net of the loans. My beneficiaries would receive that figure, almost $1.2 million. That's at 90 years old. There's my cash value. Why it's going down, because at this point in time, the interest due, assuming it stays at 5% forever, and the dividend rate stays at 6% forever, the interest due is exceeding the interest earned on the policy. You'll notice as I get older, that IRR gradually decreases. So how to offset this is 1, to pay the loan interest, B, to pay the loan off, C, add more money into the policy. Maybe I take a lesser loan initially. But even in this case, I'm not that concerned. Where my concern would come into play is if I see the policy really dipping in value and it calls for additional premium at some point in time, or says you have to pay some of this loan interest, otherwise the policy will lapse. If a policy lapses, let's say at age 90, with that $3 million loan balance on it, you're in trouble. What I mean when I say that is a large taxable event can occur. What was happened specifically is he had paid in, his cost basis was $650,000. So if you just lapsed a policy, let's say over here you cashed it out at 90, $3.8 million, all of the gains will be taxable as ordinary income. The same happens if a policy lapses with a large loan balance outstanding. So in this particular case, I paid in $650, but then I pulled out $500,000. So my input is still $150, but that entire balance will actually count toward basis or against basis if it were to lapse. So that's where I could end up with a large taxable issue there, where I'm just going to round off here. And that'd be about 2.85 or 2.9. Yeah, about 2.9. I'll just call it 285. and a 1099. None of this is tax advice, as I'm not a tax attorney or CPA, but it's important to be aware of pitfalls with cash value life insurance when it comes to loans and such. All right, let's clear everything. So this is a worst case scenario demonstrating what the policy would look like if he never pays anything back. Now, his intention would be to pay something back or all of it because he eventually wants to take income from the policy. So let's see what it looks like if he took a loan and paid interest only. What we wanted to look at here is some additional columns highlighting what he's earning as far as the annual internal rate of return and also the total cash value growth. So this is fun. You can tell you're talking to an insurance nerd when someone says, this is fun. What's fun about this is we can see what I'm paying in loan interest versus what the actual growth is. Because remember, we're still receiving dividends and interest on our entire cash value. When I pull that 500 grand out, I have to pay interest on it. But if this was a piece of real estate I owned and my home, my property is still appreciating by, call it 4.78%, same thing here, where I'm getting appreciation on the entire asset and I'm paying interest only on the loan I've requested. So this growth, instead of a return, a rate over here, it shows the total dollar amount that I'm actually growing by each year on my cash value. And then over here, I'm paying the loan interest. So loan interest comes due at $25,000. In purple represents your payments, $25,000. You'll see the death benefit much healthier in this example. Let's take a look here. As we scroll down, how does it look? If you're paying the loan interest, we never have to worry about a policy blowing up, or rarely have to worry about it blowing up, I should say. If we have a reduced paid up exercise, which we do here, we don't have to worry about it blowing up. So there's no repayments. There's the net cash value growth each year. And there's things over here. You'll see about $500,000 less than this example. When I say this example, this one compared to this one. The reason why is the loan balance is $500,000 because we constantly pay the interest. He does in this example. So the next example will be, what does it look like if he pays the interest in full, or pays the loan in full, I'm sorry. Let's take a look here. This is where it gets fun. There we go. Take a look. So in this example, what do we got here? There's our payments of $130. There's your cash value year 5. This is actual performance. Same thing over here. Here's our $500,000 loan. Loan is taken. There's your cash value. There's your death benefit collateralized. Now, in this example, we've got the interest, and then we've got the principal payment. Here, interest comes due. He pays it, plus another $65,000 per year in principal. That might be a little bit high, might be a little bit low for him too, but the goal here is to pay it off by age 62. The reason why is he does want to see potentially taking income from the policy at 62. So he could pay it back over a longer period of time. You've got control with respect to how and when you actually pay loans back. But here, we're going to pay it back by age 62. Here's what I want to hit on. In the example, before we look at this, in the example where you don't pay it back, what's your cash value and death benefit? At 61. Just about 1.1 million. 1,094,000 to be precise, and your death benefit's 2.236. What do those values look like on the far right? Exactly the same. So, if you have a life insurance policy, and you're leveraging it like a line of credit, what you will see is if that loan is repaid, your values will be restored to exactly what they would have been as if you never touched it in the first place. The only thing that can impact these values in this particular scenario is if the dividend adjusts, because you're not paying anything into it. If the dividend adjusts, the actual values will be a little bit less. Of course, we track this each year, just like we have the first 5 years. but he can leverage the policy and he has complete control and freedom to pay it back however he pleases. He's not subject to a bank or a lender saying you have to make interest-only payments or pay it back by a certain point in time. On that point, some people are okay with that. They say, I'd rather work with a bank or lender because I'm used to it, I'm comfortable with it, I can get a better cost to borrow, I can deduct the interest easily if it's for business purposes, that's what I want to do. So, in that case, we would look at a cash value collateral loan, which is assigning your cash value as collateral with a lender to obtain a line of credit. Now we've got 3% in here, which is a little little low. Interest rates have been going up. Typically with these collateral loans, you'll have a margin or a spread, depends on your cash value balance. It's anywhere typically from 0.25% all the way up to 1.25% is the highest I've seen it. So what that means is if rates prime, let's call it, is at 5%, and you've got a margin, which you'll see on the lender's paperwork, of 1%, that means your actual rate would be prime minus that margin, 4% in this example. If you have a 1.25% spread or margin, then you would be 3.75. So a lot of times you'll see insurance carriers' loan interest rates tied to prime. So a cash value collateral loan, if you have that margin, if it's an attractive one, that can work out quite nicely in your favor. But you might have a fixed loan interest rate with a life insurance policy, and if interest rates really go up, then all of a sudden you're locked in at that fixed rate. So options is really what I like to be aware of here, more than anything else. Let's take a look though. So let's adjust that. Let's put it at 4.5%. And we can adjust it each year too, if we wanted to. It's a simple workbook. Gotta work on it a little bit more. But let's assume we take a $500,000 loan to have some fun. Let's take it earlier. Let's take it this year, actually. Well, this year's just about over for them. Let's take it next year. $500,000. At 4.5%, there's the interest due, and here's the interest paid. On the far right, we've got the total interest. So I've got net interest. I should call it total interest payments that are actually paid to the lender. A lot of people like to see that. How much am I actually paying to the lender? We can do the same thing with an insurance policy loan. So I can see how much I've paid versus how much I've actually received in dividends, my cash value growth. A lot of people like to see that. I like to see that with my policies too. Am I ahead or behind the 8 ball? So in this case, I can look at the annualized IRR, which is nice. I'm still outpacing the cost to borrow. If I want to repay it, let's assume I'm going to repay it at, what should we repay it at? 30 grand per year. This would be on top of the loan interest payment. Here we go. Last year's 20,000. There you go. And we can pay it back slower or faster if we'd like. What we see here, paid a total of about $200,000 in loan interest with a cash value collateral loan, which that rate will adjust over time. But a nice way to leverage the policy. He's got this personal line of credit. The cash value asset is safe, will go nowhere but up over time, especially in this case where we look at that reduced paid up after year 7, even based on the guarantees, it's going nowhere but up. So he's got that guaranteed growth, safety, liquidity for opportunities. It's also tax-free, provided we don't lapse it or trigger a taxable event. Let's wrap this up with an income analysis. So his last question was, Steve, what does the policy look like if I take income from it down the road? So I'm not sure when. I'd like to tie it into when I might begin taking Social Security. Now he's got a lot going on just with different opportunities, businesses. He might start his own business. He's got other assets, but he'd like to tie this in with Social Security as far as a starting point. He really liked the idea or the fact that it's tax-free. There we go, that's better. So what we ran was just an income analysis here with taking income against the policy. Well, first, we looked at the growth example on the left. And then what's that policy look like if I start income at different points in time? At 62, what I did here was solve for the maximum amount of income and then rounded down to the nearest 1,000. Each year, we like to look at different projections here. It's not guaranteed. If you've seen some of our past videos where we look at properly projecting income from a policy, we like to take additional steps there and look at conservative dividends, even guarantees sometimes, which takes a while to put together, but it's important just to set expectations properly. But here we see, starting at 62, 50 grand per year coming out. He's paid in a total of 650. We can tally up the total distributions here. It's a lot more than 650, but we ran that all the way until 100. And we pulled this directly from the life insurance illustration, which you can pull up, but I won't. Otherwise, I'll talk all day about this. Starting income at 67, the longer you wait, the more you can pull. Then income at 70. And the max you can take is 80K per year. And you'll see at age 100, not too many people look this far, this far down the road, but at age 100, the values are similar with each other. It would be less if we just solved for the max, but we didn't want to completely drain it. I don't like doing that. I do like seeing round numbers. That's partly why. But always better to round down. This way we've got a little bit of wiggle room in the event dividend rates do go down or loan interest rates come up. We can just look at things more conservatively. So I hope you enjoyed this video and the last couple of videos, the whole series. If you did, please let us know. Leave a comment below, hit the like button, subscribe for more. And as always, I hope this helps. Thank you so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.